International Monetary Fund in its latest reports points out the fact that global financial stability has improved since the last report, and risks to this recovery are also lower. But it does warn that the recovery is not complete and market risks are rising as complacency is setting in about a prolonged period of accommodation. Ritu Singh is here with the key takeaways of the report. Ritu, firstly, why does IMF believe that there could be recovery around the corner?
Let's start with the good news first. Now, the IMF in its latest report says that global financial stability continues to improve as economic recovery broadens and that near-term risks to stability are lower than before. So the recent upswing seen in global activity has raised hopes for some sustained recovery. In fact, the report adds that the core of the global financial system is stronger and systemically important banks continue to enhance their resilience. But that's where the good news ends. The bad news is that global recovery is not yet complete and markets are expecting a prolonged period of accommodation before policies are normalized, and hence a complacency is setting in which can allow several vulnerabilities to build in. There are 5 such things that the IMF talks about. 1, market risks are increasing in search for higher yields and there's simply too much money chasing too few yielding assets. 2, debt levels are rising in G20 countries and the leverage in the private sector now is much higher than the pre-financial crisis times. 3, external borrowing in emerging and low-income economies has increased and this greater reliance on borrowing may at some point become a vulnerability. 4, in China, the pace of growth in the financial system, especially the shadow banking, poses a great risk given the size of that large economy. And lastly, markets also seem too complacent about a whole host of potential shocks which could potentially derail recovery.